The global economy looks fine. Markets are still moving. People are working. Cities are busy, businesses remain open, and money keeps circulating. On the surface, everything feels normal, almost comfortable. But history has taught us something deeply uncomfortable. Economic crises do not begin when people panic. They begin when people feel safe. What we are experiencing right now is not true recovery. It is delay. Over the past decade, governments and central banks around the world have learned how to slow economic pain. Through debt, credit expansion, stimulus programs, and policy interventions, they have become very good at buying time. But buying time is not the same as fixing the problem. The global system continues to function, not because it is strong, but because it is constantly being supported from underneath. Debt has become the foundation of modern growth. Governments borrow to maintain stability. Corporations borrow to maintain profits. Consumers borrow to maintain their standard of living. This creates the appearance of stability. But stability built on debt is stability borrowed from the future. Credit cards are no longer used for luxury or convenience. They are increasingly used for essentials: food, rent, fuel, and basic survival. Loan defaults are increasing, not in dramatic headlines, but in data reports few people pay attention to. Commercial office buildings in major cities are losing value as work patterns change. Entire districts that once symbolized growth now sit partially empty. Banks are not collapsing like they did in past crises. They are doing something far more subtle. They are tightening. Credit becomes harder to access. Requirements become stricter. Risk tolerance quietly disappears. This is how modern financial stress works. No explosions. No sudden crashes. Just pressure. Slowly. Relentlessly. A delayed crisis is more dangerous because it creates complacency. When people believe everything is fine, they prepare for nothing. Governments continue to spend. Markets continue to speculate. Individuals continue to take on risk, assuming tomorrow will look like today. But economic cycles are not cancelled. They are postponed. And when the delay finally ends, the impact is rarely equal. The middle class is always hit first. Rising living costs reduce purchasing power. Stable jobs become harder to find. Savings disappear faster than expected. Younger generations face an even harsher reality. They enter the workforce later, earn less relative to costs, and carry more financial risk than generations before them. For many, the traditional path to stability, education, work, saving, home ownership, feels increasingly out of reach. This creates frustration, anxiety, and uncertainty. Not because people are lazy, but because the system demands more while offering less. A delayed recession does not announce itself. It does not arrive with sirens or headlines. It arrives quietly, through shrinking opportunities, through higher costs, through the slow realization that effort no longer guarantees security. This is not fear. This is awareness. Understanding economic reality is not about predicting the exact date of the next crisis. It is about recognizing the signals before the noise begins. Because when economic crises finally dominate the news, they have already been unfolding for a very long time. The question is not whether a slowdown will come. The real question is who understands what is happening before everyone else is forced to react.